Well, greetings, my beloved clients and friends. It's been a while since we talked. I wanted to go over something that's been on my mind about the difference between trading, speculating, and investing. Okay, because in the stock market, there are operators that are engaging in three different types of operations, basically. Some are traders, some are speculators, and some are investors. And the news tends to cater more to the traders and the speculators, much less to the investors. And what we try to do in the stock market is be an investor, not a trader and not a speculator. Because I believe trading and speculating entail a lot of risk, and investing not so much. This is how Benjamin Graham defined an investment operation. He said, an investment operation is one which upon thorough analysis promises safety of principal and an adequate return. So when you're investing, you're really just looking for basically safety of principal and an adequate return. It requires a lot of thorough analysis. Okay, trading and speculation are different, and people get caught up, and because trading and speculating is what's much more highlighted, gets much more attention, and is more risky, and people should be afraid of it a little bit because it does entail a lot of risk. Okay, so, and it's confusing because all three of them, traders, speculators, and investors, are operating in the same stock market. Okay, so let's try to define the three. So trading is looking at the movement of the price and trying to detect a pattern, and from that pattern predict the next movement of that price. So traders, they look at charts. That's it. And they don't care what the chart is of. They don't really care to know a lot about the stock. It doesn't even have to be a stock. It could be a bond. It could be an option. It could be a commodity. It could be a currency. If it has price, a lot of trading activity, so you get a price and you get a chart, they'll trade it. Okay, and like, for example, you couldn't trade a house because you sell your house once every few years, right? So there's really no price discovery on a regular basis. But you could trade a stock because it's trading constantly. Every second the market is open, so there's constant price discovery, and so that chart is tracking the last sale price, and it's moving all the time because the sales price moves and this and that, and that's what the chart is. And a lot of clients, they get caught up in that because that's really the only information they have. What was the price at the end of the day today? And really, that's not even reflective because that only indicates the price on the last trade of the day. All day long it was trading, and the only thing that's recorded is the price of the last trade of the day, right? Or the last trade of the month, if they're looking at their monthly statement. Throughout the month, that thing was trading up and down and wherever. And so they get caught up in the price. And that's what traders do. And they have a lot of technology, and there's a book that was called Trend Following, and it really talks about it's like the Bible, the science of trading, and they have certain, resistance and support and lines, and there's a lot of, if you will, science to it, but all it is based on the prior price movement. They attempt to predict the future price movement. Okay, and here's the thing about pretty much all three of these disciplines. The pros have advantage over the amateurs. Okay, in trading, speed is important. So the pros, if they could get a millisecond in front of the rest of the market, it can be very profitable for them. Okay, so if you start to engage in trading, you got to realize that you're competing against more experienced pros. You're going to end up being the less experienced one in the group. So you're going to tend to not do well. Right? So that's trading. It's just looking at the chart and from that trying to determine what direction it will go. And that could be what direction it'll go in the next minute, in the next second, in the next day, in the next week, in the next month. Right? They're not looking at what direction will go in the next 5 years. They're not really looking at that. It's very short in scope. Right? And so perhaps there is some validity to their theories in the very short term that these patterns tend to create. But it's a thing where most people lose money, and a handful of experts are the ones that do okay, because they have the time and the technology and the resources and the experience to be in that market. And it's something you have to be on every second if you're trading. Right? You can't be away from your screen even to go to the bathroom if you have money exposed, because you're looking at movements. Okay, and that's not what we do. We don't do trading. So the second one is speculation. Speculation is, I could say, it's different than trading, and because people confuse trading and speculation with investing. Speculation is placing a bet on an uncertain future outcome. And if you're right, you win, and if you're wrong, you lose. Right? Like betting on the election, or betting on the Super Bowl, or betting on where a ball will fall on the roulette wheel. Right? It's going to happen in the future, and it's uncertain, and if you're right, you'll win, and if you're wrong, you lose. Right? So a lot of people speculate on investing. Speculate in the stock market. And they say, here's a company with an interesting idea, and I believe it will be big in the future. Right? That's speculation, because it could happen. And if you're right, you win, and if you're wrong, you lose. But it's saying what this company is today, it won't be in the future. Right now it's a startup that doesn't make any money. In the future, it will be a profitable company. Right? There has to be a change. Right, and there could be some wild speculation, and then there's could be some more thoughtful speculation. But it's all based on something that this company's not doing now, but I think it's going to do it in the future. And if it does, it could be very profitable. Or it could cause the price to go up, right? Like they say, oh, this company's coming out with this movie, and this movie's going to be a big hit, and this company's going to make a lot of money. So therefore, I'm going to buy this company. This company. Well, here's the thing. If you heard about this, do you think you were the first one to hear about it? Right? If it's some industry that you're deep in the know and you're well connected, maybe you knew about it. But typically, people call me, hey, Jonathan, what do you think about this? I heard about this, right? And it's something that's not their field. They just heard about it And I gotta think, by the time that person heard about it, who else heard about it first? You know? And so maybe it's already reflected in the price, even if it is true, right? So I've had people want to speculate on something, and they say, well, this company's gonna do this, so I want to buy it, right? And even if they're right, it turns out that whatever they hoped would happen did happen, but the stock didn't act the way they had expected, right? So two things need to happen. One, what you're predicting needs to happen, and then two, the stock should act appropriately. And maybe it wouldn't, because why? Because it was already priced in. Not only did you think it was going to happen, other people thought it was going to happen too, and they bet in front of you, and they drove up the price to what it should be once that result happened. All right? So, again, speculation favors the pro, the one that's real well connected, and he can't be a pro at everything. If he stays within his lane and the place where he is connected and where he is at the front of the line of getting information, maybe he could take advantage of that, right? But you can't expect the average Joe to be at the front of that line of information that would allow him to take advantage of those types of things. So that's speculation. Investing is a little bit different. One way that Warren Buffett describes it is to buy $1 for 50 cents. Okay, so investing is buying something that already has a value, right? Nothing needs to happen for it to have this value, but for some reason the price is currently below that value. There's a mispricing in the market, and so you could buy it at that discount, and then when it gets to the value that it's supposed to be, you could sell it for a profit. Why would that happen? Why would you be able to buy something for less than it's worth? Well, say for example, your neighbor that had lived in their house for 50 years, they died. And now the kids got the house, and you found out, and you know they want to sell it, and they're distraught, and they just want to be rid of it. And maybe the house is worth $950,000, but you might be able to take it off their hands for $750,000 because they just want a quick transaction. They just want to be out. And so you're able to get it at a lower price than the value, right? And so you realized, right when you bought it, you realized that $200,000 profit. Or maybe, someone's in a situation where they need cash because there's an emergency, and they say, well, I gotta raise cash, so I'm gonna sell my car. And you could buy it for way less than what it's worth because they're in a certain situation, right? So there's often times when companies will trade below their value. Why? Often related to trading and speculating, because there's other people in the market, and they're moving they're moving the price based on short-term opinions, and sometimes they get super excited and they run the price way up above the value, and then sometimes they get super scared and they run the price way down below the value, right? And so because there are so many other players in the market, not just investors, right? If it was just investors, they'd work out all the mispricings. They'd just find them up. It's called arbitrage. They would arbitrage out all these mispricings and things would be pretty much what they're worth. Because anytime something got off, an investor would come in and bring it back up to the right price. But because there are also traders and speculators in the market, they move prices much more wildly. And sometimes, a mispricing could persist because of that. So we try to take advantage of that, right? So that would be in investing, and you're buying something that already has a value because it already generates profits, but sometimes you can buy it below that price, right? So traders don't care what they're trading. They don't care if it's oranges or euros or pork bellies or options or stocks or bonds. As long as it has a price and a chart, they'll trade it, right? Speculators, they do care about what they're buying, and they have an opinion and they have an understanding of the market and the future market and the opportunity, right? An informed speculator will be able to tell you a lot about this company and why he thinks that it's going to have a certain breakthrough, right? They understand the leadership and the market and the opportunity and the technology, perhaps, or and maybe they have a good reason to believe that this company that is currently doing nothing will in the future have a breakthrough and have a lot of customers and a lot of revenue and a lot of profit, that type of thing. Investors, they also take a very close look at the business, but it's already an established business that already has a value because it's already profitable. It's just mispriced right now, right? So the company doesn't have to do anything different to be that valuable. It just has to keep doing the same thing. Like, I'll give you an example. There was an oil spill in the Gulf about a decade ago. A company called BP, right? And it was a disaster. The ducks were coming in all full of oil, and it was just a huge environmental disaster, and they faced a ton of liability, and I think they had to write like a $25 billion check at the end of the day, and it was really their fault, and so the stock went from about $60 a share down to about $30 a share. I mean, it was cut in half. But BP was a huge company, a huge established, profitable oil company. And it had this huge mistake, this unfortunate event. And obviously, nobody likes to write a $25 billion check. But guess what? Their revenues the year prior was like $250 billion. So would it pain them to write a $25 billion check? Yes. Would it ruin them? No. Were they worth half because of that, having to write that $25 billion check? No. And so it got, because of the fear and the current event risk, you know what I mean? The headline risk, the stock got underpriced. If I looked at it and I say, okay, here's what the value was before that event, and then you minus 25 billion and you take a little bit of discount, it's still worth over $40 a share, right? And so we bought it, and sure enough, sensibility came into the market after the panic, and it went back up. Not all the way up to 60, but up to 40. So there was room for that profit. So that's value investing, which is different than speculation. And And sometimes we look at the future of a company, but when we look at the future, we think if it continues to do what it's already doing, which is different than saying, something that it's not yet doing, but that it will be doing. Like, for example, we bought a company called Boot Barn, and they have about 365 stores, and they plan to get to 900, and they've been growing. They went from 100 stores a few years ago to 365, and opening about 10, 11 of them a quarter. So we're buying them because they're going to be a 900 store company, and we could buy them at the price of a 365 store company. And you say, well, that's something that they're not yet currently, but it's something that they're already doing, and they already have a plan and a strategy in place, and they're already profitable with the ones they have. So would we consider that speculation or investing? We'd call it probably 90% investing, 10% speculation. But I just wanted to give you that sense to understand that what you see on the news is often trading and speculation, and very little attention goes to investing. And really that's what we do. Okay, so hope that gives you a little bit of clarity. Hope you guys have a wonderful day.